You know, a lot is being said about overvalued stocks in the stock market. Further, we see heavily loss-making companies or companies with minimal revenue having, over-the-roof kind of valuations. So, is there a bubble building?
Now, we have to separate two things. The two things that you said. One is companies with thin balance sheets, with no top line, no bottom line, or maybe some top line but no bottom line, and so on. There, I think the thing is very simple. Buyer, be aware, or beware. Be aware or beware. I don't think there's any other thing that you can apply to these companies. Now, we take the other set of companies. You may say that, is a PE of 22 too high? You may quibble about should the PE be 19 or 22. Okay, you bought at 22. It will even out over a period of time. I don't think these things really matter in the long run. But if you are punting, then you probably are again into the buyer be aware or buyer beware category. So I would not concentrate too much on the stock market valuations. I would look at underlying growth and what that growth does to you. And is that growth going to sustain this company that you want to invest in? This would be the equation that I would look at.
Absolutely. And I think be aware and beware, I think, are very interesting mantras. So thank you for that. Sticking to the capital markets, they are at an all-time high. So as an entrepreneur, it is very tempting to raise capital at this point in time. So my question is, should one raise capital when you actually don't even require it, but external circumstances will allow you to raise it well, or should you not?
The answer is unequivocal yes.
Okay.
I've done that all, my career. So the first capital raise we did was 1988 or 89. That time I needed capital. And the Indian stock markets were, in a comatose state. So we said we will list in the US market. My investment banker said it's going to take 3 years. And then I want to do it in 3 months. And we did it in 84 days. So you did that. But segue to 2006-7, I didn't need capital at all. So, but conditions were right. Stock was right. So we did a 4 billion raise. That's now in history. When the rupee was at, 40 rupees or so at that point in time. I know it was 5 billion, not 4 billion. So we raised 20,000 crores at that point in time. We didn't need capital then, even through the Lehman crisis, even through the COVID crisis, I don't think the bank needed capital. So if you find an opportunity, you should raise capital. As a CEO, of course, you will not take shareholders' interest into account. But having that cushion is always good.
Absolutely. And so as entrepreneurs, one more word of advice, just a question, is should one take debt to grow or not? And if so, why and how much? And if not, why not?
I remember my professor from business school, going back 50 years, 54 years. His advice was very simple, that debt is a double-edged sword. Well, the going is good, but then when the going is not good, you fall on the sharp side of... So to me, that mantra is there. And again, you're all a younger lot, but most industrialists in India grew through a time when there was a mantra or an equation. Equity 1, debt 2. That was the mantra on which all businesses got built up to the mid-90s. Yeah. And then everything changed. Now, going was good, it worked. Going, slight problems, you fell on that too. The debt basically meant that you had a challenge with the company. So I would think on the debt equity front today, in today's world, definitely you should be very cautious in taking debt, and equity should be your primary focus.